Hello friends, welcome to our channel Money Intelligence. Today we're diving deep into the world of investing, and not just any investing, but the strategies employed by one of the greatest investors of all time, Warren Buffett. Now, you might be thinking, Graham, why Buffett? Isn't he all about picking individual stocks? And you'd be right, to an extent. But what many people misunderstand is that Buffett's approach to stock picking is inherently intertwined with a very specific and strategic approach to diversification. So if you're ready to ditch the generic, don't put all your eggs in one basket advice and unlock the secrets to building a resilient portfolio that can weather any financial storm, buckle up! Today we're breaking down Buffett's secret sauce to smart diversification. Think about it. If you only invest in, say, tech companies, what happens when the tech sector takes a hit? Your entire portfolio feels the pain. Buffett understands this better than anyone. That's why he diversifies across multiple industries. He's got his hands in everything from consumer staples, those everyday products we can't live without, to financial institutions, energy companies, healthcare, you name it. This multi-sector approach acts as a safety net. If one industry stumbles, he's not overly reliant on its recovery. Think of it like this. You wouldn't want to build a house on just one pillar, right? You'd want multiple strong pillars to support the entire structure. That's what Buffett does with his portfolio. He ensures that even if one sector experiences a downturn, the others can help to cushion the blow. This strategy isn't about avoiding losses altogether, it's about minimizing risk and ensuring that your portfolio remains resilient in the face of market volatility. Remember, no one can predict the future, and even the savviest investors can't always call the market perfectly. But by diversifying across industries, you're essentially spreading your bets and reducing the impact of any single sector's performance on your overall returns. So, take a page from Buffett's playbook and start thinking about how you can diversify your investments across different sectors. Are you overly reliant on one industry? Could your portfolio benefit from a broader reach? These are the questions that Buffett asks himself, and they're the same ones you should be asking yourself as you build your own investment strategy. Now, diversification isn't just about spreading your money across different industries. It's about choosing the right companies within those industries. And Buffett is incredibly picky about the companies he invests in. He doesn't just throw money at any random company in a promising sector. He's looking for companies with a proven track record of success. He wants to see strong financials, consistent earnings, and a history of weathering economic storms. But it's not just about the numbers. Buffett is also interested in a company's competitive advantage. What sets them apart from the competition? Do they have a unique product or service? Are they industry leaders with a loyal customer base? And perhaps most importantly, Buffett pays close attention to the management team. He wants to see experienced leaders with integrity and a clear vision for the company's future. He invests in companies he believes in, companies that he believes are built to last. This focus on quality over quantity is crucial. It's easy to fall into the trap of thinking that more diversification is always better. But owning a tiny piece of 100 different companies doesn't guarantee success. In fact, it can make it harder to track your investments and dilute your overall returns. Instead, Buffett teaches us that it's better to own a significant chunk of a few truly exceptional companies. These are the companies that will drive your portfolio's growth and provide long-term value. So, before you hit that buy button, ask yourself, is this a company I believe in? Do they have a solid track record, a competitive edge, and a strong management team? If the answer is yes, then you might be on the right track. Now, while Buffett is best known for his stock market prowess, he also understands the importance of balancing your portfolio with different asset classes. Remember, diversification isn't just about which stocks you own, it's about how you allocate your overall investment capital. While the majority of Buffett's portfolio is in stocks, he also recognizes the role that bonds play in mitigating risk. Bonds are like the more stable, predictable older sibling to the stock market's often volatile and unpredictable nature. They might not offer the same explosive growth potential as stocks, but bonds provide a steady stream of income and act as a ballast during market downturns. When stocks are zigging, bonds are often zagging, providing a counterbalance that can help to smooth out your portfolio's overall returns. And let's not forget about good old-fashioned cash. Now, I know what you're thinking. Cash? Isn't that just going to lose value to inflation? And you'd be partially right. But holding a reasonable amount of cash serves a very important purpose. It provides liquidity, meaning you have money readily available to take advantage of opportunities when they arise. Imagine a market crash. Suddenly, stock prices are incredibly attractive. But if all your money is tied up in existing investments, you miss out on the chance to buy low. That's where cash comes in. By having a cash reserve, you're strategically positioned to capitalize on market dips and potentially accelerate your portfolio's growth. Chapter 4. Long-term perspective. Now let's talk about one of the most crucial aspects of Buffett's investment philosophy, his long-term perspective. Buffett isn't playing the short game. He's not trying to time the market or make a quick buck. He's in it for the long haul, and this long-term mindset is woven into his diversification strategy. When Buffett invests in a company, he's not thinking about what's going to happen next week, next month, or even next year. He's thinking about the company's potential 5, 10, even 20 years down the line. He's looking for businesses with sustainable competitive advantages, strong earnings potential, and the ability to adapt and thrive in a changing world. This long-term perspective allows him to ride out market fluctuations. He knows that there will be ups and downs, bull markets and bear markets, but he remains focused on the bigger picture. He understands that time is the investor's greatest ally, and that by holding on to great companies for the long term, he allows the power of compounding to work its magic. So the next time you're tempted to panic sell because the market took a dip, remember Buffett's long-term approach. Instead of reacting emotionally to short-term fluctuations, focus on the fundamentals of your investments. Ask yourself, has anything changed about the long-term potential of the companies I own? If not, then stay the course and trust in the power of time. Chapter 5. Concentration in high-quality investments. Now here's where Buffett's approach to diversification might surprise you. He's not afraid to concentrate his investments in a select number of high-conviction holdings. You see, while diversification is often touted as the holy grail of investing, Buffett understands that there's a point where too much diversification can actually work against you. Think of it this way: if you own a tiny sliver of hundreds of different companies, you're not really invested in anything. Your returns become diluted, and it becomes incredibly difficult to keep track of all your holdings. This is what Buffett refers to as diversification, spreading yourself too thin and ending up with a portfolio that lacks focus and direction. Instead, Buffett advocates for a more concentrated approach. He believes in owning a significant chunk of a smaller number of companies that he knows like the back of his hand. These are the companies that he has the utmost confidence in, the ones that he believes will deliver the best returns over the long run. This doesn't mean you should put all your eggs in one basket, but it does mean that you shouldn't be afraid to allocate a significant portion of your portfolio to your highest conviction ideas. Remember, the goal of investing isn't just to own a little piece of everything, it's about owning enough of the right things to make a meaningful impact on your overall returns. Chapter 6. Avoiding over-diversification. Now let's be clear. Buffett isn't saying you should throw all caution to the wind and dump your entire life savings into just one or two stocks. That's not smart diversification, that's just reckless gambling. What he's advocating for is a balanced approach, a strategy that combines the benefits of diversification with the power of concentrated, high-conviction investing. It's about finding that sweet spot where you're sufficiently diversified to manage risk, but not so diversified that you dilute your returns. The key takeaway here is this: diversification is not a one-size-fits-all proposition. The right level of diversification for you will depend on your individual risk tolerance, your investment goals, and your time horizon. If you're younger and have a longer time horizon, you might be more comfortable with a more concentrated portfolio. You have time to recover from losses and the potential for higher returns. On the other hand, if you're closer to retirement and need to protect your nest egg, a more diversified approach might be more appropriate. There's no right or wrong answer here. It's about finding what works best for you and your unique financial situation. Remember, diversification is a journey, not a destination. As you gain more experience and knowledge, your approach to diversification might evolve. That's perfectly normal. The important thing is to be conscious of your diversification strategy and to make sure it aligns with your overall investment goals. Outro final thoughts. Hope the above video is helpful to you. Remember, Diversification is key to building a resilient portfolio, but it's not just about spreading your money around. It's about making calculated decisions, choosing quality companies, and taking a long-term perspective. If you find it useful, do like, share, and subscribe. Your support helps us create more content like this and share these valuable insights with a wider audience. Feel free to comment if you'd like to explore more about other topics. I would love to hear from you. Let's keep the conversation going in the comments below. Thank you, and see you in the next video. Until then, keep learning, keep investing, and keep building your financial future.